This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In our first session together on loss reliefs, we saw how it was that we may relieve the loss sustained by a business, an unincorporated trader, in a business that was a normal ongoing business, i.e. we were not dealing with the specific problems of either opening years or closing years, both of which issues, of course, we'll have to contend with later during this particular lesson, this particular lecture. But if I can just remind you of the example that took up most of our time on that first lecture, whereby we were illustrating the normal ongoing loss reliefs. We set up the information about the income of the taxpayer using a normal income tax computation format of our trading income, any earned income, before then dealing with any unearned income, down to total income, took away any reliefs deductions from it, and then got the personal allowance to come away in deriving our taxable income figure. And we copied the numbers down. The only thing, again, if you recall, that we had to remember to do was where there was a loss, as there was for our current tax year, 15-16, we put in a nil assessment rather than a bracketed loss figure, a negative figure. We knew that if any loss was to be carried forward, then it would go against the next available future trading profit. And that would have been against that £50,000 there. We then listed out any other amounts chargeable for the year. Now again, we may simply have to copy down, or they may test us in terms of basics of the bases of assessment. The property income is assessed on an accruals basis, that interest is a received, dividends is a received basis, and dividends must always be grossed at 100/90, and bank deposit or building society interest, the two major examples of interest received net, and that therefore had to be grossed at 100/80. And so it was that we would get our total income figures, here our total income for the current tax year, that was the £8,000, and the preceding tax year. We didn't put anything in there for the following year because we didn't know whether there would be any trading loss carried forward to deduct there against the next year's trading income. We then considered the loss reliefs. Now what we considered was the application of the loss in the current tax year and or the preceding tax year. We saw that it would be a ridiculous computation to deduct any current year relief because we had our personal allowance of £10,600 there, as it is to be assumed for each of the tax years, and our total income was only £8,000. So we made no current year claim. And instead we came in with a preceding year claim that then had to be, as the loss was £40,000 if you recall, as the loss relief then had to be in full against the entire total income. Now that would have given you immediate relief and a repayment of last year's tax. Last year we would only have been a basic rate taxpayer, of course, and the tax saving would have been at 10% in relation to property income and bank deposit interest. In terms of dividends, of course, then we were only talking about a 10% tax rate, but that 10% tax charge would be covered by the 10% tax credit, so actually we'd only be saving any tax payable in relation to the other non-dividend income. But it still meant that that personal allowance was being wasted. Now, what you might therefore have considered, and you may have been thinking about this since our last session together, was that maybe it would be better here to make no claim in the current year and also no claim in the preceding tax year, and to go with a very much simpler outcome, and that would be to carry forward all of the loss. Let's just look at what the effect of that would be. If we carried forward all of the loss, then in here, let me just get rid of that arrow, but in here we'd have the entire £40,000 loss being deducted. Now that trading income next year was big enough to absorb the entirety of the £40,000 loss. That therefore would have reduced that income down to, the trading income down to £10,000. When we then add in our other amounts chargeable, our property income, bank deposit and dividend income in gross form, that's another 8,000 to add in, is 18,000. And of course this time you would then get full use of your personal allowance. It would still leave some, what's that going to be, £7,400 worth of taxable income, but you wouldn't waste any of your personal allowance. The claims that we made before, that preceding year claim, wasted that personal allowance. Now not doing it will be wasting no personal allowance, not in the current, not in the preceding, and not indeed in the next year. Now that would clearly be an advantage of a carry forward. There'd be one other big advantage as well. Just look at what the next year's figures would have been. Without that loss coming in, we'd have had £50,000 of trading income. We had £8,000 of non-trading income. So the figure in here, instead of 18,000, would have been 58,000. So when you deducted your personal allowance, 10,600, 10,600 from 58 would have left you with a taxable income of 47,400. Now that 47,400 has come down to 7,400. Obviously it has, because we've used the £40,000 loss. But look at what that income would have been, 47,400. And look at the tax saving that could now be achieved. With our basic rate band limit being as it is, at just £31,865, that basic rate band limit there, that would have meant that much of the tax saving, the use of the £40,000, would here have saved tax at 40%. You'd have got a higher rate tax saving. Now that is a critically important issue for us to be aware of. The fact that when you look to use losses, what are the objectives we're trying to achieve to get the best use out of those losses there? Now then, what we have seen is that we are looking to use losses as early as we can, because if you use losses as early as you can, like we did in the last lecture with that preceding year claim, it means we would have got a repayment of any tax paid last year. But on last year's income, we would only have paid tax at 20%. On this year's income, the income would have been £58,000 less 10,600. That would have left you with taxable income of 47,400. That would have been above your basic rate band limit. Can't remember what figure I might have said a moment ago, but that should be 31,785. I think I might have said 31,865. Going back to last year I am there. My apologies. 31,785. And the excess from 31,785 up to 47,400 would have been taxed at 40%. So by carrying forward the loss, you are losing out on the tax repayment. So in cash flow terms, the carry forward is not as good. You are reducing next year's tax that will not be payable until sometime after next year, rather than getting an immediate repayment of this year's of the previous year's tax. There'll be no repayment. So in cash flow terms, the carry forward is not as good. But here it would probably be the best thing to do, because now the tax saving would be partially at 40%, so you'd get a 40% tax saving rather than just 20%, and as well as relieving tax at the higher rate of 40%, you would be wasting none of your personal allowance. So these are important objectives that we strive to achieve in terms of getting the best use out of the losses. Let me just write down for you what those objectives as regards the use of our loss reliefs will be. What these objectives are that we have just discussed. Now, in terms of order of importance, I would suggest to you here, what we would have is the first two are equally important, and that is you'd like to gain relief at the highest tax rates. As we have just explained, I would rather take out income that would have been taxed at 40% than to remove income that would have been taxed at only 20%. If I can get a higher tax rate, higher rate saving, then I'm doubling the tax saving. I am removing income that would have been taxed at 40% instead of only removing income that would have been taxed at 20%. My tax saving is twice as big. This is clearly a good move. And what is also important is to avoid wasting the personal allowance. Now those were problems in terms of what we did in the previous exercise. In the previous exercise, we did get some relief at the highest tax rate because we carried forward, I think it was £8,700 worth of the loss. But look back at the answer to the example in the previous session. You should have that in your notes in front of you now, in point of fact. But it still left some tax being paid at the higher rate. And what we'd done was to waste the personal allowance of the previous tax year. Nothing you could do about the current tax year. Again, some of that was going to be wasted, whatever. But now, by carrying forward all of the loss, all of next year's higher tax rate band would be removed. All of the higher tax rate taxable income would be removed. And we would have avoided wasting the personal allowance. The only downside of now our revised answer, which is simply carry forward all of the £40,000 loss, is cash flow. That it would always be better to use a loss sooner rather than later. If I can carry the loss back to the previous year, as we did last time, then I'd get an immediate repayment of last year's tax. If I reduce this year's income, if there had been some taxable income, that is, if I reduced income this year, then that would reduce this year's tax. If I carry forward, then that will reduce next year's tax, and I'm going to not actually get any benefit out of that loss in cash flow terms immediately. The benefit would only flow to me when next year's tax would otherwise have become payable. That, again, the pay dates we see in a later lecture together. So, in terms of last time's example, we showed you that in that example that you have available relief against total income in the current tax year and or in the preceding tax year. Because this year, the current year's income was low, it was less than the personal allowance, we made no current year claim. But we did suggest a prior year claim relieving against total income the preceding tax year, because that would give you immediate relief. We were also demonstrating, of course, how the loss relief would be applied, and that then any balance of loss would be carried forward against the future trading profits of the same trade. What we've now done is to consider the other and maybe preferable and very much simpler option, which is just to carry forward the entire loss of £40,000. In that way, all of next year's higher tax rate taxable income, the 40% taxable income, would be removed. All of that higher rate band would be removed, and we would avoid wasting the personal allowance. So we ticked off both of those objectives. The only one that wouldn't do is to achieve a better cash flow. The carry back option is always the better cash flow move. Right, give that again some consideration. Go back over what we have just said. Make sure you're happy with the principles. Because in terms of an examination question, what a question may ask you to do is to consider to state what all of the available options are, current year and or preceding year, plus the possibility of carry forward, either by itself or after having made current and previous year's claims. State what claims are available. It might then state to make the most efficient claim at the earliest available opportunity. The most efficient at the earliest available opportunity, which means don't go with the current year claim because you'd simply be wasting the personal allowance, but go with the preceding year claim. Or then it may ask you to then recommend what do you think would be the most beneficial claim. Most beneficial, and that's where you'd identify these objectives. Relief at highest rates, avoid wasting personal allowance and cash flow. And you could then recommend the simple carry forward of that loss, because it would take out all of the income that would otherwise have been taxed at 40%, your higher tax rate taxable income. You'd have avoided wasting any personal allowance in terms of the preceding year. And the only downside is you didn't have cash flow. But if I can get a much higher tax saving next year than I would get as a tax saving and repayment from last year, then as long as my cash flow position allows it, then it would be better to carry forward. Right, give that some thought, and then pause and then come back to us, and we'll continue with the next part of our loss relief study. Okay, well, there's just one further issue that we need to consider now in dealing with loss reliefs made in the current tax year and or in the preceding tax year. You may or may not recall back in the previous session when we first got introduced to these reliefs that we mentioned that a cap, a maximum, a limit would apply in relation to how much loss could be used against the total income in either the current or the preceding tax year. Let's now look at the detail of this. Now, again, it is unlikely that in the majority of circumstances for most taxpayers that this cap would ever be applicable. But of course, we're dealing with examination questions, and of course now with objective testing questions, any individual points of detail may of course be tested. So let's have a little look at how this works. So here we go in our Chapter 7 notes in Section 4, Part C there of a cap applies that limits the amount of loss relief available against a person's total income to the higher of, so not the low, but the higher of £50,000. So always, therefore, at least the £50,000 would be available. But if higher, it is unlikely that it would be a figure of 25% of the person's adjusted total income. Now, that's a new expression. We haven't seen that one before. You have seen an expression, adjusted net income. Now, that net income, of course, is a figure that we know is the figure of income prior to deduction of our personal allowance. And adjusted net income, again, if you recall, back in Chapter 2, adjusted net income was after we had made a couple of deductions from net income. One of which, and it's applicable here, was the deduction of the gross amount of any personal pension contributions. So here's your definition of adjusted total income. That is your total income after deducting the gross amount of any personal pension contributions. Now, personal pension contributions were paid net of basic rate relief being given at source, and indeed in a later chapter we will be dealing with all of the tax issues pertaining to pension contributions, be they personal pension contributions or be they something called occupational pension contributions. Suffice it to say at this point that if you had made an actual pension contribution of £8,000, then the gross amount, 8,000 times 100 over 80, would give you a gross figure of £10,000. If I just squeeze that in there, that would be £10,000. So adjusted total income after the gross personal pension contributions. Now, for that figure to be relevant, we're talking about 25% of the person's adjusted total income. So unless that adjusted total income is more than 200,000, 200,000 at 25% would equal £50,000. Now, we know that you've always got that figure. It's the higher of 50,000 or this 20% of the person's adjusted total income. So unless the adjusted total income is more than £200,000, the £50,000 figure is the higher amount. So it's very, very unlikely that that second one is going to apply. Just basically remember, £50,000 is the cap. Now, importantly, the cap does not apply to any trading profits within the total income figure. Now, where this will be relevant, and I'll show it to you in a moment in our example, this will be relevant to a claim made in respect of the preceding tax year. In the current tax year, when you make a trading loss, the trading profit assessment is nil. Therefore, there is no trading income figure. But if you go back to the preceding tax year, as we did in our example last time, and as we just discussed again in this lecture, if you went back to the previous tax year, then you would hope that there would indeed be a trading profit in there. Well, this £50,000 is exclusive of the trading profit. There's no limitation against trading profit. The 50,000 cap is only against your other income, your non-trading income. Now, the cap will only be tested F6 within this section of relief against the total income of current and or preceding tax year. Now, again, all you know at the moment is reliefs against total income are the current and the preceding tax year. A little bit later, hopefully, we'll get an introduction to it in this session, where reliefs, a very specialist relief, is available in opening years that also goes against total income, and where too this cap would in practice apply, but that won't be tested. It will only be tested here, this cap, in the context of current and or preceding year relief. So let's have a little look at our illustration here. Louise Sir, no doubt she's called Lou for short. Louise Sir has always prepared accounts to April the 5th in each year in respect of her trade, while also receiving employment income of £60,000 in each tax year. So she's got both employment and self-employment. So she has employment income each year of £60,000, a figure you will see strategically located above £50,000. For the year ended April the 5th, 16, she made a trading loss of £125,000, having made a trading profit of £20,000 in the year ended April the 5th, 2015. Right, so what have we got here? We've got information about the 15-16 and 14-15 tax year. So far as the trading profit is concerned, we were told in the year ended April the 5th, 16, that of course is synonymous with your tax year. Using CYB, that's a nil assessment, a loss there for the year ended 5th of April 16 of £125,000. Now, whatever is the level of loss, 125, 25, 100,000, whatever, the assessment is nil. There you see it. In the previous accounting year, year ended April the 5th, 15, that ends in the 14-15 tax year, trading profit 20,000, there it is. So, we set up our computations for the two tax years concerned, current tax year 15-16, preceding tax year 14-15. Because the current year is a loss, the assessment is nil, and we put the £20,000 in as the assessment for the previous year. Employment income, £60,000. Right, add up and see what we've got as total income prior to any loss reliefs applying. The total income, 80,000 in the preceding, 60,000 in the current year. In the current year, 60,000 is all non-trading employment income. Assume the personal allowance for 15-16 is also available for 14-15. There's your £10,600 worth of personal allowances deducted. Compute the taxable income for each of these tax years, assuming that loss relief claims against total income are made in both years there. Now we will have a loss, of course, of 125,000. Let's see how then it would be applied. If we make the claim in the current year, your total income there is £60,000. It's all made up of non-trading income. It is employment income, 60,000. So here the cap applies. 50,000 is your maximum claim. But in the preceding year, you've got trading profit of 20, no restriction in terms of a loss relief claim, employment income of 60, maximum 50 against that. So the cap 50 applies yet again in relation to your non-trading income. Employment income 60. You can only relieve 50 of that 60. But there's no restriction as regards the trading profit. Therefore, all of the 20,000 can be removed, plus 50 of the 60, so the loss relief there is 70,000. Now look again carefully at that, make sure you understand where the 70,000 applies, where it comes from. No restriction against trading profit, but your other non-trading income is capped at 50. 20 plus 50 is £70,000. And it will therefore leave income, in fact in both years, of £10,000. The cap of 50 has applied against the employment income in both the current and the preceding years. It leaves 10,000 of that 60,000 employment income still chargeable. This is in fact here good news, because it leaves that income not quite sufficient, but nearly sufficient to cover the personal allowance. Had the caps not applied, you'd have taken out the 60,000 in the current year, and then, well, again, you'd have had only 60 out of 125. You'd have had 65,000 to go against the previous year. At least in one of those years, you would have wasted the personal allowance. Obviously, you could have chosen which of those years to firstly make your claims in, but you'd have wasted at least one of those years of personal allowance. That's not happening now, with only a little bit of the personal allowance being there wasted. Okay, what have we got? Loss relief claim, as we've said in 1516, capped at 50,000, and that's higher than 15,000. I wouldn't bother again in a question showing this, but that's 25% of your adjusted total income. 50,000 is obviously the cap. In 1415, the loss relief claim is made in full, as we just said, against the trading profit. That was 20,000, but the cap of 50,000 applies against the remaining total income, i.e. employment income. So the total loss available in that year would have been £70,000. The cap here, as we've just said, can be seen to be in fact of advantage to Louise, as it leaves sufficient total income in both years to absorb not quite all, but the vast majority of the available personal allowance of 10,600, bringing you down to nil taxable income in both years. The remaining trading loss of 5,000, where does that come from? We've used 50,000 there, 70,000 there. That's £120,000 in total used out of, again we'll ring it again, the £125,000 of actual loss. So 5,000 available to carry forward. What do you carry it forward against? Against the next available trading profits of that same trade. Next available trading profits of the same trade. So again, have another little look through how that cap has applied and where it has applied. So just pause it for the moment if you need to, before we then move on to the next part of our loss relief claims. If a taxpayer makes a claim against total income in the way that we've seen in the current tax year and or the preceding tax year, and after a full claim has been made, there is still some loss remaining, some of the trading loss still remains, then what we have is the option to go for a very different type of loss relief. Remember, this is a trading loss that we're dealing with within the income tax computation. Yet here we see in Part D of this section that we have the ability to relieve a trading loss against our capital gains. Now, I know, at this point in time, we don't yet know how to calculate a chargeable gain, how to calculate an allowable capital loss, and how to work out capital gains tax. No, we don't know that. But we don't need to at this stage to be able to understand the nature of this relief and what it allows you to do. When we come obviously to Chapter 12 and we deal with capital gains, then we'll see more detail in relation to that. But suffice it to say at this stage that if the taxpayer has made the full available claim against total income of the current tax year or the preceding tax year, then for the tax year in which that claim has been made, if there is still a trading loss that remains after that claim against total income, then subject to a cap, as we'll see in a few minutes' time, the trading loss that remains will be able to treat then as a capital loss of the year. So we can take a trading loss, put it against our capital gains, and therefore reduce our CGT liability as a result. Okay, let's see what the details of this therefore are before working a little example. This is often known as an extension claim, because it's only available as an extension to either a current year or a carry-back relief claim against total income. And as we said, it may only be claimed after such a claim against total income has been made against that total income. So this is not to begin with a standalone claim. For the tax year in which you wish to make the claim, be it the current year or be it the preceding year, for that particular year you must already have made your current year or preceding year claim against total income. And you must have made, as we only can do, a full claim against such income, but there's still loss remaining. Now that loss that remains can then be relieved against capital gains, but as we've said, only after the total income of the tax year in question has been reduced to zero by the trading loss. Well, I say reduced to zero, obviously having just seen the cap applying, what we're making the point of, if you've made the maximum possible claim against total income, it usually would indeed bring that total income down to zero. Then only at that point can you then go on and treat the remaining loss as a capital loss of the year. Okay, how do we do this? The remaining unrelieved trading loss following your total income claim is restricted to a maximum loss as shown below. We'll come to that point below in a few minutes' time. Again, it's not usually an issue in terms of an exam question. So, having computed what is the loss available, it's then deducted from the net gains of the year, i.e. gains less losses of the tax year. Again, just like with income tax, we have a CGT liability in respect of a tax year. Same tax year, 6th of April to 5th of April there, and we work out our chargeable gains on disposals, any allowable capital losses on disposals, and we net out to get the net gain for the year. And against that net gain of the year, we can now apply this extended loss, taking this trading loss and setting it off and treating it as a capital loss of the year. That loss relief is applied before you then deduct any capital losses that may have been brought forward from previous years, and also before deducting what's known as the annual exempt amount. This is a level of tax-free gains. It's the CGT equivalent to your personal allowance. Your personal allowance here in income tax is a level of tax-free income. Well, your AEA, your annual exempt amount, is in CGT a level of tax-free gains. A level which for this tax year, the 15-16 tax year, runs a level of £11,100. That is our AEA. Okay, on that basis I'll come again to the maximum loss in a moment's time. But let's just go over the page and look at a little example. So in 2015-16, Kathy has a capital gain of £44,000. She's got trading loss relief available of £24,000 after a claim against the total income of the tax year has been made. Remember, to access this relief, you must firstly have made the maximum possible claim against total income of the tax year for which you wish to make the claim. So here in 2015-16, Kathy will have taken the trading loss, set it off against her total income. That would usually have the effect of reducing the total income down to zero, because the total income will usually be less than the £50,000 cap that applies. So she's reduced that total income, made the maximum possible claim, and still has trading loss available of £24,000. Okay, what can now happen to that? Now, what we said we would do is to establish from your CGT computation what were the net gains. Now here we've been told that she has a capital gain of 44,000, no reference to any losses. Were there losses in the same tax year, you would deduct them from the 44,000. So the net gains for the year, just the gain of 44,000. But I stress, you would take away any capital losses given within the question as well. What can we now do? Subject to that maximum loss calculation, I'll go back to it in a few moments' time, we can then take this loss relief. We can now take this extended trading loss relief. How much was the loss available? 24,000. 24,000, deduct it from the 44,000 to bring us down to net gains after the loss relief of £20,000. At this stage you would look to see, are there any losses brought forward? No, there are no losses brought forward, but what you would have available is your annual exempt amount, AEA, our annual exempt amount, which is at a level of £11,100 for this tax year. Take it away and we will then derive our taxable gains, which when we come to our CGT chapters we'll then see how we would go on and tax. But here we would have taxable gains of, what would that be, £8,900. So it's very simple. Apply your trading loss in the given tax year against total income. Having made the full possible claim, there is still trading loss left over. You now, if you wish to make this extended claim, it is a separate extended claim that must be made, you may then treat that remaining loss, subject to cap as we'll see in a moment, as a capital loss to set off against the net gains of the year. Now, as I say, that would be the net gains, which from your CGT calculation, you'd have picked up as here, any chargeable gain, and reduce that gain by any available capital losses of the year. After you've established the gains after the trading loss relief has been applied, then look to further reduce those gains, here the 20,000, by, if they exist, any capital losses brought forward, or what will certainly exist for every year, the AEA, our annual exempt amount here of 11,100, and it brings you down to your taxable gain, and the job is complete. Let's just have a little look back at the cap that applied. It's this last point here. Now, what we've seen is you were told in that question that followed that the trading loss remaining after having applied against total income was that figure of, what was it, £24,000, I think, there. Right, what is this maximum that may limit that 24 to a lower figure? The maximum loss available for use in this relief is computed as the net gains of the tax year less any capital losses brought forward. So, in our example, what were the net gains of the year? Well, there was only a gain of 44,000. Had there been losses, we would have deducted them. We have a net gain of 44. Take away from that any capital losses brought forward. Were there any capital losses brought forward? No, there were not. So this maximum claim here is 44,000. The loss available for relief is only 24,000, and on that basis we apply, as we have already applied, the full 24,000. But if there'd been losses of the year, they would have to be netted out against the gains of the year, and had there been any capital losses brought forward, they too would have served to have reduced what now would be the maximum loss available. If that figure had come below £24,000, the trading loss that remained after your income tax loss relief claim, if the figure had been below 24,000, then that figure is the maximum figure you could then have used against your gains of the year. That is the figure that would have gone in instead of 24,000, the lower figure, if this maximum claim had been applicable. We'll talk more of that when we come to CGT in Chapter 12 indeed, when we know more about how to calculate gains, how to calculate losses, and indeed how to apply capital losses both of the year and of any losses brought forward. That brings this particular session to an end. What we will be doing in our next chapter is to look at the very specific circumstances that apply in opening years, where we have losses that arise in opening years. How do we compute the loss relief available? You will for this have to go back and revise your bases of assessment in opening years from the previous chapter there. I would advise you do that, unless of course you are more than comfortable already with those rules, but make sure you know them before we progress to that next chapter. What we will then see is, having computed the loss available for any tax year, in addition to the rules that we've seen, the reliefs that we've seen already, the current year, the preceding year claim, the carry forward claims, the extension claim here even against capital gains, that there is then a specialist opening year's relief that is also available to us. All of that awaits us in our next lecture.